welcome to Enterprising. Shakespeare once famously said, "A rose by any other name would smell just as sweet." Well, it's a good thing he wasn't an entrepreneur, because if he were, he would have had to choose from a plethora of options. For instance, should you start up as a company or as a partnership? Well, this week, Isha Dalal looks for answers to that fundamental existential question: to be or not to be a corporation.
Constructing a building is hard work. It requires a clear-cut vision of what the final structure will look like, what it's going to be used for, what building materials are required, and how quickly it needs to be in place. Well, entrepreneurs laying the foundations of their brand new business ventures need to have just as much foresight when choosing structuring options for their companies.
Option number 1, a sole proprietorship. A sole proprietorship is owned, as the name suggests, by a single individual. No registration is required while setting up this kind of entity, but other formalities such as PAN card registration, VAT and service tax registration have to be completed before starting operations. This entity is taxed at the individual rate of income tax, 30.9%, which is about 3% lower than the corporate tax rate. All that's often attractive to small traders, shop owners and family-owned businesses. But if you're an entrepreneur looking to scale up, then here's the flip side of being sole proprietor.
As a sole proprietor, though you have the benefit of enjoying all the profits of your firm, at the same time you're equally liable for all the losses. So then your personal assets, your maybe your home, your deposits with the bank, your various assets can also get liquidated in case something goes wrong in a small setup like that. Another limitation which definitely one has to keep in mind is, as a proprietor you may have a very limited expertise in terms of running your business. You may be a very good manager on operational side, you may be very good in planning, you may be good in governance, you may be good in compliances, but you may not be good in marketing. So how do you promote your business if you're not good in marketing? So those kind of hurdles.
Hurdles that can be overcome using option number 2, a partnership.
The first step is finding someone you can partner with, people who share your vision, enthusiasm and responsibility towards the business. And these people should complement your strengths. If you're a big business leader, your partner should be a detailed, obsessed person. And then it's time to draft the partnership agreement. That's especially important if you're entering into a business with friends, because nothing can ruin a business faster than souring personal relations and verbal agreements that have gone bad.
The agreement should clearly spell out who does what, how profits are to be split, and even how to dissolve the partnership in case you need to. While drafting the partnership agreement is not easy, you definitely want to do this with the help of legal and tax experts. And then you need to register the partnership with the registrar of firms. This could take anywhere up to a month, but operations can begin prior to that as soon as the partnership agreement is in place. A partnership can have anywhere between 2 to 20 partners. Legal liability is unlimited and is evenly distributed amongst all partners. But, unlike in the case of a sole proprietorship, a partnership is subject to a corporate tax rate of almost 34%. But despite that, IIT alumnus Nikhil Dhoka, who set up an SMS marketing service earlier this year, chose to kickstart his venture as a partnership.
We were not very clear, when we started, at what is going to be the stock holding between the partners, how is it going to work, are there going to be external partners coming in, when will we raise money, how will we raise money, would it be an individual or a VC firm that would be investing. So all these things, stock holding things were not clear, plus it takes time to register a private limited. So partnership was very easy to start with.
Partnerships are easy to form, quick to register and easy to manage. But things are not so easy when it's time to bring in an external investor.
If there is a partnership firm with 3 or 4 partners bringing in different kind of expertise within that particular firm, they would not be very comfortable of inducting a 3rd or 4th unknown individual into the firm, because then obviously their profit sharing ratios and all of that would have to get rehashed.
So we come to option number 3, a private limited company or PLC. A PLC structure has 2 main benefits. Number 1, all shareholders enjoy limited liability, which means that their personal assets are safe even if the company defaults. And number 2, it's easier for investors to pick up a stake in a PLC. That's because they don't have to renegotiate partnership agreements as they would have to do if they were investing in a partnership. And that's exactly what prompted B. Ramesh to set up his green transportation venture EcoMove as a private limited company in August last year.
If I approach a VC or a bank or anybody as a sole proprietor, they will be less interested in investing us because it's anyway a proprietorship company with less and less legal requirements to follow. In a private limited company, there is enough disclosure, enough kind of filing of certain information to the regulatory authorities, etc. required, and therefore investors who are there will be much more comfortable investing in a private limited company rather than sole proprietorship.
On the flip side, the PLC is far more complex when it comes to registration, compliance and taxation. The company registration process is over 6 weeks long. It includes bringing on board at least 2 directors and securing director identification numbers, a name search process at the ROC to legalize the entity's name, drawing up and registering the company's Memorandum of Association and Articles of Association, and finally securing a company identification number or SIN. Besides, a PLC has to pay higher taxes, the 34% corporate tax rate plus a dividend distribution tax for the profits it distributes to its shareholders.
But that's the price to pay for building a venture that can be scaled up considerably. In fact, many young entrepreneurs who start off as sole proprietorships or partnerships often dissolve their existing structures and go the PLC way instead.
Well, there will soon be option number 4, which allows entrepreneurs to have their cake and eat it too. That's the brand new limited liability partnership or LLP structure, which was made possible by an act of parliament last year. LLPs can induct an unlimited number of partners, but each partner enjoys limited liability. That's attractive enough for consultancy and legal service firms who are usually not looking for external investors. But for other kinds of businesses, the limited liability partnership is still not as investor friendly as the private limited company.
So you can go solo, you can partner, or you can incorporate. But if you're an entrepreneur looking to scale up and find other people to invest in your business, then your best bet is the private limited company option. So here's hoping you keep good company no matter which option you choose. In Mumbai, Isha Talal.
Right, with that, it's a wrap on this edition of Enterprise Inc. If you have any startup queries or would like to pitch your business plan to an at enterpriseinc@in.com. We'll be back next week, same place, same time. Thanks for watching.